morning and welcome to our mortgage market update with David Luna. Please let me introduce the president of CAMP, Ms. Audrey Boissino. Audrey?
Thank you so much, Megan. Good morning, everyone. Thank you so much for joining us. It's gotten to be quite the pleasure to spend Tuesdays at 11 a.m. with so many of you. I just want to say thank you so much to Megan Jackson, who is always so important with regard to organizing and putting on all of these events. Kevin Casey, who is always helping our president-elect for CAMP, and Dave Luna, who we all love. Just a few reminders before we get going. Be a member of CAMP, please. I am asking this of you and would really appreciate it if you go to thecampsite.org and either join or renew your membership. We are getting a lot of really good response from all that we've been doing, and we have a lot of new members, which is really exciting, and people who may have fallen away for a little bit and are coming back. So for that, we are grateful, and it is not we can't do this without everyone being involved. CAMP is essentially run by volunteers, and we need everyone to be a part of it. So thecampsite.org. Also be on the lookout for the calls to action that we have been sending out, and you're going to see more of these going forward. So we've done a call to action asking that the SBA receive new funds to help small businesses. That cry was answered, and the SBA opened up their new process on Monday with the idea that it will probably be out by Friday from what I'm hearing. So we will probably circle back to that when you'll see that again. We've also asked that the GSEs purchase loans that are in deferral and forbearance. The jury is still out on all that. And then the next thing you're going to see, we finally have the system in place as of this morning and are working on putting together a call to action regarding rent. There is a proposal to decrease rents in the state of California by 25% across the board. So just do the math and imagine what impact that will have on all of our investors and small mom and pops, not just the big guys, but the little guys are really going to be hurt by something like that. So you'll see that coming out in the next day or so. So be on the lookout. We are going to have Ginger Bell back on Thursday at 11 a.m. She did such an amazing job on Zoom and video. There are so many people who tuned in and really saw and figured out a new way for them to go forward in their business. So we will be sending out that registration shortly. And Friday and Saturday this weekend, we're going to do Mortgage Educators NMLS 20 hours. Kevin Casey is going to teach that. And so if you know anyone who wants to get into the business, who is in the business but needs to get their NMLS, et cetera, definitely sign up. It'll be a great class, and it's yeah. There you go. May 15th, Dave Luna is going to do our NMLS 8 hours. Don't laugh at me, Dave Luna. So look for that. And then on May 28th, Kevin Casey is going to do another NMLS 8 hours, so you can knock out your continuing ed as you're sitting at home. And just a reminder that you can feel free to send questions through the chat during this session, and we'll be doing a Q&A as we always do. And just know that we have a number of upcoming events. We're working on putting together something on credit. We are ready to do a non-QM panel at this point. We're getting that put together. So continue to send us your good ideas if you have some. And with that, I send it to you, Dave Luna. Tell us what has happened in the last week. Anything?
So what has happened since last Tuesday? A lot. So some of the stuff you might know, some of it may be totally brand new to you. Let's tell you what's going on. So the Labor Department reported Thursday that the total number of unemployment is now at 26 million. Boo, that's bad. Wednesday from FHFA, oh my goodness, they still haven't gotten their act together. They said due to COVID-19 pandemic, some borrowers have sought payment forbearance shortly after closing on their home and before the lender could deliver the mortgage to Fannie and Freddie. Mortgage loans either in forbearance or delinquent are ineligible for delivery under enterprise requirements. Hang on. However, today's action lifts that restriction for a limited period of time, and I don't think everybody's understanding the period of time component, and only for mortgages meeting certain eligibility criteria. Eligible loans will also be priced, ouch, to mitigate the heightened risk of loss to the enterprises from these loans, end quote. So this is absolutely ridiculous because these loans were done, a national emergency occurred, the GSEs charged a guarantee fee, and now on top of all of that, they're going to charge a delivery fee for forbearance loans of approximately 600 basis points or a 6% fee. If you look at Fannie Mae's letter LL 2020-6, or in other words, the sixth letter to come out in 2020, that's 6% of the loan's value. So let's do the math on that. For example, a first-time home buyer getting a loan of $500,000 would be hit 5% or $25,000 hit to the company. Guys, not only did you do the loan for free, it costs the mortgage company you work for to make that loan. Another option would be just to keep the loan and hope that the borrower can pay it back, or foreclose and cross your fingers that the loss won't be that expensive. So I want to bring in our companion association, the MBA, and their president, Bob Brocksmith, who said, quote, unfortunately, the agency, meaning FHFA, authorized the GSEs to apply what we believe are excessive loan level price adjustments to these loans. 500 basis points for first-time home buyers, 700 basis points for other loans. The agency also excluded cash out refis altogether, which means those loans remain unsellable to the GSEs at this time. So what in the heck is up with that? So the GSEs will be buying these first payment forbearance loans on May 1st, 2020, just in a few days, for loans with notes dated February 1, 2020, or after, but only until May 31st, 2020. Everybody was stuck on the 5 and 7%, and nobody looked at the time frame. The time frame is not very long. So loans in forbearance with closing dates after May 31st will not be eligible for purchase under this new policy unless they come out with something else, and we'll talk about that a little bit later. So let's look at this closer. The CARES Act is clear about forbearance. It says, quote, if a furnisher makes an accommodation with respect to one or more payments on a credit obligation or account of a consumer, and the consumer makes the payments or is not required to make one or more payments pursuant to the accommodation, the furnisher shall report the credit obligation or account as current. That is the problem. So these are GSE eligible loans with the guarantee fee that's been paid on them. However, the guarantee fee doesn't come into play until the loans are delinquent. So if they are marked current, according to the law just passed, they are not delinquent at the time of going into forbearance. Therefore, get it? The clock hasn't stopped. The GSEs win, or the GSEs win at the loss of the rest of the industries. The GSEs really need to buy these loans if they were underwritten and approved according to their guidelines. So when the forbearance ends and the borrower begins the repayment plan, then they are still current under the new law. If the borrowers later default, then the GSEs own that risk. That's why there's a guarantee. So guys, it's really super simple. It's either a GSE loan or it's not. It can't go both ways, okay? If an originated loan is not sellable to the GSEs, then it's not government guaranteed, and it is not eligible for forbearance. So please understand how tricky this is and how people are being held ransom. It's very unfortunate, and I'm going to give you an example, before we end, about a very large lender that just says, you know what, we're out of here, forget it, we're done. If a borrower becomes unemployed after a loan is closed, but before it's sold to the GSEs, an option is to foreclose. If the borrower can't make their payments, the lender can try and sell the loan to the private market, not to Fannie and Freddie, and generally they're going to take a hit of about 15 to 20%. try and do a loan mod, meaning that, you know, the options just aren't there. Foreclose, loan mod, there's options, there's just not great ones. And so when they're saying, okay, then pay us 5 to 7%, it's just very, very frustrating. Anyway, yesterday, FHFA announced during this national health emergency, no one should be worried about losing their home, said Director Mark Calabria. No lump sum is required at the end of a borrower's forbearance plans for enterprise-backed mortgages. What? So I've been telling you that some servicers are saying you're going to have to pay a lump sum. So we're glad for the clarification that came out yesterday that they do not have to pay a lump sum. Fannie Mae then has created a new website called, quote, Know Your Options. On the site, it shares important info. Plus, they put out a YouTube video that kind of explains the same thing. They're saying that a lump sum payment, of course, is an option to get yourself back on track. Making up missed payments over time. Okay, so maybe you're going to pay a little bit more with each payment, or maybe entering into a loan mod. Also, no late fees will be charged during the forbearance period. So you're marked as current, no late fees. I can see why people are opting into the forbearance route, which is super, super dangerous. Anyway, that's Fannie. Freddie Mac CEO David Brickman made the following statement. Simply put, if you're a homeowner seeking forbearance and Freddie Mac owns your loan, let me hang up on that one. Okay, you are never required to make up missed payments in a lump sum. Our policies offer a number of options to bring borrowers current, including repayment plans, resuming normal payments, or lowering your monthly payment through a modification. We encourage homeowners, got to scroll down, give me a second, facing hardship to work with their servicer to identify the plan that's appropriate for their situation. So full payment, known as reinstatement, that would be an option where you pay back the missed payments and quickly get back on track, a repayment plan, or a payment deferral or modification. So as I told you several weeks ago, it's the FHFA's policy to pull from smaller lenders that can't quite make all the payments to a larger one who can survive the forbearance challenges. So the CFPB jumped in and they said, what happens if your mortgage servicer changes to another? They had a statement April 24th, 4 days ago, stating consumers should experience a seamless process when their mortgage servicer changes, said CFPB Director Kathy Kraninger. If you want to see the full announcement, go to the CFPB's website. MBA, their survey numbers released yesterday afternoon put the forbearance approximately at 7%. Now we hear these numbers, but we don't know how many loans that means. So we did a little bit of math here. That's 38 million loans that are in forbearance. 38 million loans from April 13th to April 19th, because it takes a while to get all the numbers out. May's numbers will be interesting to see. If we're going to experience more in forbearance, or was it just the month of April? It will greatly depend on when we can all get back to work and, do we see another jump up in forbearance requests? So June will be an important month telling us if we're either flattening the curve, to borrow from COVID, or it's moving in the wrong or right direction. Let me tell you a casualty because of FHFA's statements. Ready? Mr. Cooper announced yesterday that they are temporarily leaving the wholesale channel. That's what they said. Now, they're a huge lender and their website has the following message. Let me read it to you. Quote, alert, capital letters, exclamation point. As a result of COVID-19 pandemic and its national and global impact, we have decided to temporarily suspend the ability to create and submit new loans, end quote. It's not temporary, guys. All of the people that worked in wholesale have now got different positions in different areas. Not everybody could be absorbed by Mr. Cooper, who is also a lender. There are some people that won't be staying with the entity, so it doesn't sound temporary to me. What's happening with applications? Most are refinances, 25% are new purchases, so 75% are refi, 25% new purchase. So purchase business is happening. Speaking on the slowdown, NAR chief economist, Dr. Lawrence Yun said, quote, buyer and seller activity is only temporary, with a majority ready to hit the market in a couple of months, end quote. I'm telling you, and now others are telling you, that we will see, an increase, but it's not going to happen until, again, my prediction would be midsummer, somewhere around July, just for round numbers. A recent credit availability index showed a dramatic 16.1 fall in March, with jumbo availability plummeting a whopping 37%. This news has been poor for rates. They'll be going kind of up and down, but longer term, it looks like the rates should continue to come back down. How much and how fast, still up in the air. But we just continue to watch it. In terms of price, it seems far safer to hedge loans now compared to a few weeks ago. So more and more stability is coming back into the market. Our president mentioned about the PPP, the Paycheck Protection Program. So because of everybody's efforts, remember they ran out of money, lawmakers passed another approximate $500 million, $500 billion in funding this past week, which will give small businesses access to more assistance through the SBA. The measure passed the Senate on Tuesday, passed the House on Thursday. President signed it. This is the fourth stimulus package, including the $2.2 trillion CARES Act. Is there a fifth stimulus package in the works? The answer is yes. Dave, how big is it? Is it going to be like 500 billion again? No. This thing again is going to look like, in the fifth stimulus package, it's going to look like it's going to be close to $2 trillion. So the debate is going on right now, and because it's so big, don't look to see anything new passed until guesstimating second, third week of May. Just don't hold your breath. The money, everybody be careful. If you get the money, and congratulations if you do, it needs to be used for payroll and other expenses like insurance premiums, mortgage, rent, utilities through June 30th. As long as 75% of the money goes toward keeping workers employed and maintaining salaries, the loans which are guaranteed by the federal government, listen, will be fully forgiven. Now, what happens to unqualified companies that are receiving the funding? Guys, they need to return the money, or quote, according to Secretary Mnuchin, they could be subject to investigation. And the Attorney General's office is looking at that. And I don't mean Attorney General of the state of California. I'm talking about the federal government. A quote from them is they work with many business owners, and they'll be applying for the PPP money from the AG's office. This is federal. Quote, there is a potential that there will be fraudulent or false statements on the loan application, or non-existent businesses attempting to dummy up paperwork to get the money, said Assistant Attorney General of the Justice Department's Criminal Division, Brian Benkowski. Up next, the Federal Reserve. They hold 8 regularly scheduled meetings per year, and we're in it right now. The FOMC, the Federal Open Market Committee meeting, started today. It'll end tomorrow. Announcements will be coming out tomorrow. So let's see what the heck the feds are going to do. We always watch to see if they're going to drop rates, but with them at or near zero, they can't really do that. So let's see what happens next. Market liquidity has greatly improved since March 18th. It'll be interesting to see what will happen. So if they really can't drop the Fed funds rate, they will probably announce something to T-bills and less on MBSs. The California legislature is set to return before we meet again on May 4th. So maybe some mortgage-related bills will get some new attention. I always want to wrap up with some good news. So let me tell you some good pieces of information. So Dr. Elliot Eisenberg, who's an economist, stated in his blog 5 days ago, quote, the data is no longer all dismal. Car sales may have stopped falling. Consumer sentiment and consumer expectations of the future are no longer declining, and demand for oil and gasoline has bottomed. This suggests that we are beginning to hit bedrock end quote. I absolutely agree with Dr. Eisenberg. I think we have already hit the bottom. From Rob Chrisman today, U.S. Treasuries began the week by pulling back, mostly due to general optimism about lockdown measures being relaxed in Italy, France, and the United Kingdom, demonstrating how connected the global economies, or at least investor sentiments, are. Deutsche Bank announced better than feared Q1 results, adding to the positive sentiment, end quote. Weekly forbearance requests as a result of service portfolio volume dropped. It dropped. So less people were asking for forbearance from last week. Look at the stock market today. Look at it yesterday. The stock market was way up yesterday. We haven't ended the day yet, but it was up 50 the last time I checked. It was up 64 the last time I checked. So over 400 points, going above 24,200. That is above its 50-day moving average for the first time in over 2 months. Why? Because states are making plans to reopen. The stock market found the trend very favorable. Everybody likes what's going on. I think we hit rock bottom, and I think we're coming out of it. I think the economy will soon start to heat up as those shelter-in-place restrictions are lifted. States are looking to open their economies soon. Businesses are making plans to reopen. For example, down in Fremont, Tesla plans to reopen the factory. So Ford, Chrysler, and GM are also exploring reopening options as well. Ladies and gentlemen, I got permission to do this. Remember I told you non-QM was coming back. Remember I told you that. From Angel Oak, today I received this quote, effective immediately. The leader in non-QM, Angel Oak Mortgage Solutions, is excited to offer a full doc and business bank statement product, end quote. Now, they wanted me to direct you to their website. Some of you guys should have received that announcement. Almost immediately after I got it, I started getting non-QM emails as well from others. So I think it's back. It's not what we had before, but it's gonna be a gradual process. Now, most of you guys know that I grew up in Southern California. All right, so in Southern California, besides it being super blistering hot, it was really good to see that golf courses, beaches, and other areas are starting to open up. The good news is people may be coming back to work very, very soon. Hopefully, it's a carefully measured, healthy return to work for many. I think the worst is behind us. I hope the worst is behind us. And Audrey, I've been concentrating so much on what I had prepared. I haven't looked at any of the questions. Kevin, Richard, Joe, good to see all you guys. Sonia.
Okay, so we've got the questions, baby. Don't you worry.
All right, so I'm doing several things at the same time. So Facebook Live and Camp, and we're doing it all at the same time. Okay, talk to me. What are the questions?
Okay, so let's start with something that just popped out of what you were saying, which is we've only had a 37% drop in jumbo. It feels like it was bigger than that. Am I wrong? Obviously I'm wrong, but where did that number come from, I wonder?
Let me go back. I forgot where it was. Give me a sec. I think it was bigger than that as well. I don't think. Oh, yeah. So this comes from MBA. Their MCAI, which is the Mortgage Credit Availability Index, showed a dramatic fall in March. Jumbo availability, so not everybody went on the jumbo market, plummeted a whopping 36.9%. I just rounded it to 37%.
I see. That's going to be an interesting number to follow, I think. But maybe it'll come back before, yeah. So what's next? Okay, let's talk about the difference between conforming pricing and high balance pricing. Right. They want you to talk about the discrepancy, and you know that the de minimis is one of my little favorite things to talk about. So let's talk about that, David.
Why don't we let you go first? Okay.
Oh, why? God. All right.
No. So, give me your opinion.
Okay, so as most of us know that the reason, so a certain percentage of the loans delivered to Fannie or Freddie have to be conforming, and then you can only have 10% be high balance, right? When somebody described the way they calculate how they come up with the actual number, it's crazy. Like, it needs to change. And I didn't realize that it was something that Fannie and Freddie set. So it's not this 90% number.
Come up with high balance.
Pardon me?
You mean the formula that Fannie and Freddie used to come
Correct.
up with? Okay.
Right. And then the idea that you have to have a certain percentage that's like baby conforming versus high balance. So I think we need to have a conversation about how we change that
formula
percentage, because it's not working for the for us in California. We need to be able to deliver more high balance to Fannie and Freddie. It's really important. These are not rich people. This is a group of borrowers who need this money, and it should be affordable, right? What do you think, David?
Oh, I think so. Again, I told you I grew up in Southern California. So when you look at Beverly Hills, when you look at Bel Air, when you look at Westlake Village, when you look at Thousand Oaks, when you look at San Diego, when you're in East Bay, when you're in San Jose, when you're in San Francisco, no, there are many areas in both Southern and Northern. Sorry, Bakersfield. Sorry. In Southern than well, I mean, come on, right? What do you get for $500,000 in Bakersfield? You get a mansion and a pool. No. There's lots of different areas, and it's not just California. I mean, think of Hawaii, think of other places as well where
right, absolutely,
positively needed. But I don't know that there is enough places around the country where they're going to do that. I mean, I get New York, I get the Boston area. I mean, I get that there are pockets. There's just not enough of those areas to, unless you live there and unless you're trying to do business there. But I mean, you go to Texas, which is the fastest growing state in the country, and for, I don't know, $350,000, $400,000, you're picking up 5,000 plus square feet and a pool and at least a third of an acre. So there's just some places that are just not high balance, and there's just not enough places for them to adjust the model. They're just not. I
think we should at least start having the conversation, because prices continue to increase, and it really does impact. And we're not talking about rich people. And there is a disconnect across the country where people think that if you're buying $1 million place in San Jose, you're rich, and they don't understand that that's a fixer-upper or a tear-down. And there you go. So here we are in California. So that's a whole subject. That's kind of a minefield.
Yeah, we're not going to solve that one today.
No, we are not. So they are asking, how is forbearance coded on your credit report? And we talked a little bit about this last week. We talked about Dave Stevens showing one of the major banks showing a forbearance on a credit report. Do you know anything new this week?
Nothing new this week. I think there was somebody that actually talked about it here recently of how it shows up on a credit report. I was giving you my interpretation and somebody else was giving you theirs. So you get a room full of, let's say 20 attorneys. Probably going to get 20 different opinions, but seeing that I have the floor right now, let me give you mine. So again, it has to be marked as current. So if you've done, work with credit reports at all, other than looking at the, the 3 scores and trying to find the mid score, if you actually read the report, the report shows whether a payment was received that month, and any lender worth their salt can see where the months were where the borrower did not make a payment. Now, I think you said somebody differently actually showed forbearance or something across the credit report. So why don't you take a moment and talk about what you saw, or what credit bureau or lender or somebody reported. What did you see?
Right. So it was a big bank, and Dave Stevens posted it, I think, on LinkedIn, a picture of it with obviously things redacted, but it showed that someone was in forbearance. It literally said forbearance across the bottom of the account. And so, again, maybe they didn't sell it to Fannie and Freddie. Maybe that was, I don't know, but it is a little different than what we were told was going to happen. And I think it's going to be interesting to see it play out.
So the CFPB, which is over the credit bureaus, looking at the Federal Law CARES Act, says it's got to be marked current. All right. Now, whether a lender marks it as current or not. Now, forbearance and deferral, those aren't new terms. Those are student loan terms. So if we look at student loans, how are student loans? When the student comes out of school, they don't have a job, they don't have the income, they're in residency, whatever, then, payment, something happens to that student loan. It's either a deferral, forbearance, whatever. So these are terms that have been around for years, and the credit bureau understands them. So you could have a minimum wage person that's sending information to the credit bureau and goes forbearance on their keyboard, that may not know. Who knows? It's a lender that says, okay, this one is in forbearance. It just happened to be at the timing that everything else is hitting the fan, but they were in forbearance and we were working on it for a month or two before it got to this point. So it really is forbearance on a private, company owned loan, not a Fannie, Freddie, or Govy loan. Who knows?
Right. So another person said, know your option states that both the post-forbearance options of repayment plan or modification results in a lesser credit impact versus foreclosure. Does this imply that credit is impacted post-forbearance? My understanding is that during forbearance, credit is not impacted at all. So I guess there's the during and after difference that they're asking about.
That's a brilliant question. See, we don't know what's going to happen after forbearance because here we are in the middle of everything. Yes, we see that there's less people asking for forbearance. I don't know how that's possible, because if you're still unemployed and the number is getting bigger, how did forbearance requests fall, by almost 2%? Yeah, I don't understand that one. But anyway, all that we have right now is it has to be marked current, not in forbearance. Again, we just had that conversation. What's it going to look like? Sure. Well, if it's current and it's not going to affect your credit scores, then I'm assuming that the effect will be extremely limited. However, if now we finish the forbearance period, whatever that is, a month, 2 months, 3 months, 6 months, 12 months, whatever that period of time is, and now the individual can't make their payments, boom, that thing automatically is going to be reported as probably foreclosure or loan mod, thinking back to what we were going through, back in 2008. So it's going to be a very, very interesting world when we see of those 38 million loans, what's going to happen to them later.
Right. Well, and we had another person that wanted to clarify. Oh, where'd you go? Your sound is missing. David? I can't hear you anymore, David. Can you hear us?
Hey, David, can you hear us?
Ah, there we go. No, I don't think he can hear us. Okay, I'm glad I can hear you. David? Hello?
He's talking, but we can't hear him.
That's odd. He has had a lot to say, too. He cannot.
No, he can't hear us. Yeah, we can't hear you either.
That's odd.
Very
David,
odd.
maybe call in.
We can do the old-fashioned way. It's a good idea.
Call in through David, call in through the number. Okay, so
hold on.
while we're trying to figure.
There he goes. Put him on speaker. David?
Yes.
That works. Can you hear me, Audrey?
I can hear you.
There we go. That works. Technology.
All right.
Audrey, you have any more questions?
So yes, we have many more questions. Okay, so we didn't hear like the last probably 30 seconds of what you were saying, David. Do you want to repeat it?
I forget what I'm saying. Yeah.
Okay, well, so we were talking about credit, and somebody wanted to confirm yet again that that we cannot refinance people in forbearance, and the answer has been a resounding no so far, right? You haven't heard anything different than that, have you? Okay. So I'm interested to see later when somebody, you know how when you're doing a loan and at the very end, the underwriter wants to update your credit report to show that the payment from last month was paid.
Right.
I'm just curious to see how they end up showing that eventually, because there you go.
Okay. So let me, because I'm having to hold my phone close to my ear and I don't know that everybody can hear everything.
We can. Now we can.
I don't know the audience is. So the question was still on the credit report, what will it show? Will it show forbearance? Will it show late? Will it show anything like that? Guys, we're still in the middle of things and we have no idea what it will look like when we are out of this forbearance mess, and what people's credits will look like if they cannot get themselves back on their feet in a short period of time. So again, whether it's a repayment plan, whether it's a payment deferral, meaning putting it on the end, whether it's re-amortizing the balance of the loan, whether it's doing a modification of the loan, reducing the monthly payment, there's options. But what happens if none of those works and it goes into foreclosure? Ouch. We don't know. It hasn't happened yet.
Yeah.
So we say it's just speculation.
I agree. Okay, so we've got a couple of questions on this. It says, please address that we, LOs at the broker level, and by the way, it's everyone. It's not just the brokers. Everyone's dealing with this, are being threatened with EPOs on all loans we've done, requesting forbearances, etc., for all loans going back 6 months and going forward. How are we supposed to pay back this money? And then also a similar question, but in the same vein, is what is David's opinion that at the end of the day, should brokers be concerned about EPOs as it may be related to forbearance or deferment?
Okay. So the question was, as loan officers, should we be concerned with either EPOs, early payoffs, or forbearance if it's beyond the broker's control? Ladies and gentlemen, we sign those broker agreements, and if those loans are, if the money that we were given is requested back, then you're starting to understand what these servicers are going through when they have a guarantee and they make a loan thinking a borrower's going to make the payment, and the borrower doesn't make the payment, yet they have to go ahead and advance the payment onto the investor. Now at a smaller level, every single one of us is understanding what those servicers are going through. So hopefully there's a little bit more empathy, specifically on EPOs. Interest rates will continue to fall. And so if that borrower pays you off within 6 to 12 months, whatever your agreement is with whatever wholesaler you're working with, then you're going to have to pay it back. Audrey, you and I were on a mastermind conversation thread, discussion group where the loan officer saw at 179 days the loan was refied and sent back to the same lender, and that lender wanted from the loan officer their full commission. Remember how we talked about that one last week?
Yes,
yeah.
Absolutely.
So it depends on the contract that you sign. Is it 180 days or more? I mean, guys, we still don't know what the heck is going out there. And these EPOs go on for like 6 months. We're only in month 1. We have no idea what's going to happen in the future. But it looks like if you're a broker, you had the lender underwrite it, you had the lender approve it, you had the lender fund it. It looks like on that case, if the lender can't get it off their books because of forbearance, that is not our problem. So the question was a 2-part. What happens on EPOs? It's absolutely our problem. If we've sold it and now it goes into forbearance later, that's a problem for somebody else. So they priced that risk, hopefully. They got the guarantee fee. They should be protected. They should be able to float it at least 4 payments according to last week's statement that that's all they're going to be on the hook for is 4 payments. And so we hope that no wholesale lenders get in trouble. Again, we just talked about Mr. Cooper yesterday. bowing out of the industry. So we hope they don't get in trouble, but it's still too new to call, guys. It's just way, way, way too new to call. I don't think loan officers are going to be hit with forbearance, repurchases, or repay back of commission. But EPO is still very, very, very much on the forefront. And we signed it in the contract.
The EPO issue is a big one, and you and I have talked about this, and you know that it is a concern of mine, to put it mildly. I just saw something yesterday from somebody who just got hit with his fourth EPO in a very short amount of time, and this is from a lender who has decided to not just do the 6 months, but has notified a certain number of their brokers that they are going to retroactively change their EPO period to 12 months, and they really believe that they have the right to do this. So there's a lot of concern out there about EPOs, and I think that it is going to be something that we need to address as an industry going forward. I think that there are ways that we could put safeguards in place for us, and while understanding that we want to make sure we're protecting the consumer, but to do a 30-year fixed loan where the borrower has absolutely no skin in the game in terms of having to pay points, et cetera, and then having somebody refinance them out of there 3 months later, it's not a sustainable model, as we're starting to see,
let me
believe.
repeat for everybody that you can't hear Audrey. So what she says is there's another lender that was made an announcement recently that they're extending EPOs not from 6 months but to 12 months as well. And Audrey's suggestion, recommendation is for the industry to kind of band together to talk to those lenders and say, no, you can't just arbitrarily change contract just because you want to now have a longer period of time on EPOs. So that's so far what Audrey says. There may be a call to action by your association. And please, these are the times to be involved. These are the times that when a call to action hits you, speak up, say something, have your voice counted. Don't just sit back and say, oh, Kevin Casey or Audrey Boycino or Dave, those guys will handle it. No, it's all of us together. Okay, I just wanted to repeat to everybody what you were saying.
No, that was good. Hey, Dave, I have a question that came on top of that one, and that is just someone asked the question of, is there a way that doc close and the borrowers must sign accepting liability for the EPO? I know the answer to that.
Go ahead, Ben.
First of all, we can't have a prepayment penalty, because if we have a prepayment penalty, we have to include that fee in the fees of our initial closing disclosure. So that's why
we have to disclose it on the LE, and you have to disclose it on the CD, because if it's a prepayment penalty, it's got to be disclosed.
Right, and that's why people think that prepays are against the law. They're not against the law, but the fees would wipe out your ability to do the loan, because you would pass up all your 3% cap and fees if you had.
But my whole point is that whole conversation and the way the rule is structured needs to change, so that everybody understands, the borrower understands what they're agreeing to. And again, we're not discussing prepays, a 3-year prepay on a 228, subprime loan. We're talking about, have a reasonable amount of time before the borrower refinances out of a 30-year fixed mortgage that they just got for free. So again, I'm not talking about taking the rules as they are today. I'm talking about changing it. I think we need to talk about changing it. And actually it's something we could do where investors could agree that they will not buy a loan at Fannie and Freddie. Let's start with them. They won't take a loan that's been in place less than 6 months or whatever. So again, I'm throwing out ideas. I know it's not necessarily a popular conversation, but I think it's one that's important that we need to have as an industry, because we're starting to see the effects of the way we've been doing it not working.
So she's sitting there saying we're starting to see the effects of the way that business has been done in the past not working. It's taken this pandemic to bring certain things to light. We see lenders changing EPO programs. We need to now get the borrower involved so that the borrower knows what is at stake if, for example, they pay it off early, et cetera, et cetera. So there may be, I don't know, Madam President, there may be a call to action. We may need to think about it a little bit longer before we come out to you guys with a proposal. We may also want to have input from you as to what your thoughts are and what do you see happening. what suggestions do you have to solve this? Because you don't want to work, for a while to put together a loan, and then the borrower, refinances out of it, and all of your work not only was for free, you have to pay all the money back. Some of us, we work really, really hard for our money and don't really feel comfortable giving it back, a month or two later, or 4 or 5 months later, or almost 6 months later if the borrower chooses to refinance. The borrower needs to be aware of what the heck is at stake and what's going on. Okay, Madam President, I think we agree with you. Ladies and gentlemen, we do apologize for the sound. I have no idea what happened. Now that, pretty much everybody is online and trying to do, work from home and things like that, we do apologize for the technical difficulties. All right, any other questions?
It sounds like it's working on the GoToMeeting, but it's having an issue on the Facebook Live. So again, somebody's asking about interest rates, and do you still believe that they'll stay low? And what do you think we'll see with VA and FHA loan rates improving? What do you say, Dave Luna?
Okay, so the question is, do I still feel that interest rates will be low? Do I still feel that interest rates will get better over the long haul? I actually do. I think that interest rates, again, they can't really, really, really go any lower. Stop. The Fed funds rate can't really go any lower. But if you're looking at the trend, say from the end of March, right? So not necessarily March 18th when things were really bad to March 24th. Let's just take March 27th to now. Okay, so that's a month. If you're looking at it, interest rates 3.4, 3.6 for 30-year conforming, for 30-year FHA, you have seen them come down. And I think they will continue to come down. It's not because 10 years are, getting skinnier. It's below 1. What is it now? 0.64, 0.67, somewhere in that range. Remember, changes on a daily basis. It's because the availability of credit will become more loose. It's because people will go back to work. It's because, we have a lot of equity that is tied up in people's homes. They're going to have to pay for everything that we're going through right now. Yes, they're saving a little money because they don't have to put gas in the car, but they still have all those other bills, mortgages and utilities and food and everything else. And when people go back to work, we're all going to go out and support all those businesses. At least I am, right? And these are our friends. These are our neighbors. These are the people that we want to see succeed. So if the unemployment now drops back down to where we were before, and we still have equity, and now people are working, and interest rates are in a low rate environment, the rates are going to continue to go lower. They will continue to go lower, and they will go lower this year. Just look at the trend over the last 30 days.
Right. So we have a question, and I think that this is something we can address next week. Since housing is such a critical component of the economy, and LA County plays a major role, any insight what CAR is doing to get the market reopened? And I have I'm having some conversations with CAR, so I'll get a good answer to that by next week.
Okay, so
unless you've talked to them recently.
Answered next week. Audrey's going to address that next week. Guys, I won't be with you next week. I miss you. I won't be with you. But really, really good news. I'm trying to help the economy, trying to help realtors, trying to help builders, trying to help, right? I'm moving into my new house, so I won't be with you next week. But we have some really, really important people, not like a Dave Luna type. I mean, important people that are going to be with us to share some really, really cool answers, and also to break it up so that you're not always listening to me. And so I happen to know who the special guests, plural, are. So we're going to leave that for Audrey. We'll leave that question for next week when it'll be answered a little better.
Okay, so first of all, I just want to make sure you understand we never get tired of you. And any time that you want to join us, you are always welcome. So you go ahead and move next week, and then I will continue my onslaught of begging you to come back and do some more of this. So we are getting towards the end of.
If you can't hear her, she's being very, very gracious and saying some nice things, which I won't repeat because it might sound a little, I don't know, boastful. So she's just being very, very nice, and I am being invited to come back and visit with you guys later on.
Well, invited is not just the word I'm using, but anyway, so there is a question that I've heard of this. I don't think it's enforceable. Are there any LOs out there having their borrowers sign an acknowledgement that if they refinance within 6 months, the borrower needs to reimburse the LO for the lender credit?
Is there any acknowledgments out there where the borrower has to reimburse the loan officer if they pay it off in 6 months? Hey, good luck with you, on that one. My opinion, I'm not an attorney. Yeah, good luck in trying to enforce that because you can't hold a borrower hostage. You just can't. So if you guys are doing it and your attorney's good with it and your attorney feels that they can defend that in court, hey, congrats. I don't think it's enforceable. I really, really don't. Kevin, what do you think? Do you think something like that's enforceable?
No, that would be a little bit of a challenge to enforce that. You can ask the borrower, and what I do with all my borrowers, I just explain to them what happens if they pay off a loan early. And
yeah, educate the borrower.
Educate them. And and in my entire career, I've only had one, thank God. And that guy was a loan officer who knew better. Can you believe that one?
That's ridiculous. That's terrible.
Day 175, he paid off the man. Yeah, don't trust other loan officers.
Dang.
Okay, so we got an amen to that for my comment that we never get tired of you, Dave Luna, and hugs and kisses coming your way. I just quickly want to interject a quick little bunch of numbers that Jason Bellevue shared with me this morning about the updates with SBA. So there was $320 billion reallocated. $60 billion was allocated to banks with assets of $50 billion and below, with 30 of that going to banks with 10 to 50 billion in assets, and 30 billion going to banks with under 10 billion in assets. So really, really important, A, to reapply, B, go with smaller banks. He told me about one client that he was able to help who applied with Mechanics Bank and got their money within 4 or 5 days, just now. They are saying they believe the funds will be out by Friday, and reaffirming what you had said, that they are going to audit and go after the businesses that shouldn't have taken the money, but did. So they are really that's going to be a push, and the big banks aren't allowed to do the robo-auto data entry anymore, so that's something. And the SBA limited it to 350 apps per hour. Anyway, they're trying to put things in place to help the little guys. That's really the bottom line. So
okay. So Audrey, if you did or did not hear, again, of the almost $500 billion that was allocated in this last round of funding, there were a little bit more guardrails, parameters put in that it really is for the small business person to continue to keep their doors open and to pay their people under the PPP Paycheck Protection Program. And she also mentioned that the auditors will go after the bad actors who should have never got the money in the first place. They need to give it back, or that lied on their application to get the money in the first place. So that's what she said. Audrey, it's really, really hard to hear you. I'm holding the phone up. I don't know if everybody else can hear you. So, ladies and gentlemen, we've now hit about the top of the hour.
No, he's lost.
Okay, we lost him again. All right, kids. So with that, we're going to wrap this thing up and remind you that we will be with Ginger Bell at 11 o'clock on Thursday, 20-hour class this Friday and Saturday. And then next Tuesday, we'll do our normal 11 o'clock on Tuesday industry update with some surprise guests, which we will announce shortly. So with that, have a wonderful week and a wonderful day, and I will look forward to hearing from you next. Thank you. Bye-bye.